in Tata Power, PI Industries. So all of that could support the market today. There you have it, the first tick on the index. Nifty absolutely flat, just consolidating around 19,400. The mid-cap index is having a better showing, so the broader markets are looking pretty good, up about 116 odd points for the mid-cap index, and the advanced decline ratio is solid at 1,600 stocks on the advancing side. Let's take it straight to the gainers now. BPCL, Adani Ports, ONGC, Apollo Hospitals, your top four gainers. Dr. Reddy's has been gaining quite a bit of ground. In fact, this year, Dr. Reddy's is now up 30%. Apollo Hospitals, Divi's Labs. So, Pharma is doing quite well this morning. Let's take a look at Lupin because that's the one that's, delivered a good set of numbers. So, Lupin should be up for you on your screen in a minute. 1.5% higher there post-earnings. You have M&M coming out with earnings tomorrow. So, up about 0.4% on M&M. Hero MotoCorp is looking pretty good as well. L&T, Asian Paints, and a couple of other stocks that are trending in the trending in the green right now. On the red side, you have Tata Consumers, Tech Mahindra, Axis Bank, Bharti Airtel, and HDFC Bank. So, in general, the consumption space is a bit under pressure. Britannia, HUL are in the red. Eicher Motors comes out with earnings tomorrow. That one is a tad bit in the red as well. So, you'd have to say, give and take everything, it's not a bad opening, flat, but at least holding on to the gains of yesterday.
Well, that's right, Sonia. We're getting mixed numbers actually in terms of result reactions. A few of these stocks that are getting a bit of a knock this morning should come up for you on the screen. MTAR Tech, that stock is down close to around 8%, so that's seeing a big sell-off out there. You have Organics, that's down close to around 6%. It appears the street didn't like these numbers too much. GNFC is down close to around 4.5%. MTAR Tech is now down close to around 10%, so big cut being seen out there. Avalon Tech as well. Remember, these stocks have run up a good deal, but the numbers appeared a little bit disappointing. So you have Avalon Tech as well that's under some pressure. HEG, well, the management had told us actually in the past quarter that the next quarter as well will be fairly muted. And the numbers were quite muted as well. So HEG has opened up with a cut of around 3%. And Sri Renuka Industries as well is lower. So those are about the stocks that are losing and most of them reacting to numbers. On the gaining end, you have Welspun Corp. Well, the numbers look quite good. There's a ramp up in terms of pipe volumes. Also, they got a good amount of order book and debt has come down. So Welspun Corp is up close to around 5%, I think, as we speak. GMR Power, that's one of the top volume movers today. So that as well is up close to around 5%. It's locked in upper circuit. Ashoka Bilcon is another name that's moving quite well. So those are quite a few stocks on the broader markets that are moving around, most of them reacting to numbers. But I think from the frontline F&O names, just trying to pull up a few stocks out there. GNFC, that's a loser. You have Oil India as well, that's under some pressure. While on the winning end, you have PFC. That stock is up a good 3%.
20 points lower. So, as we were saying in the morning, maybe it's not going to be a bad thing if you spend a day or two consolidating a little bit, maybe a little bit sideways possible. We'll see. 20 points lower is what we have on the Nifty. This is just the start. Take a look at what we have on, some more names. So Tata Power, and you'll hear from the management in just a bit from now, it's down 3%. So Q1 was soft and Q2 is actually okay, but I mean, compared to consensus expectations out there, it's a bit of a miss once again. United Spirits, McDowell, that's down about 1.7%, 1,081 on United Spirits. Tata Elxsi will come up, and these are large, the big volume-led losses. Price-wise, 1.5% cut, but there are volumes, 8,118. There is Oil India, which is down 3.5%, so that's a direct oil play. Oil prices go down as a production company. What they're able to get in terms of realization goes down as well. Cupid, which had a frenzied move recently higher, is down about 5.5%. HEG is down about 3.6% as well. And look at Mama Earth, which is Honasa. It basically, I think, started trading at about 330, and it's at about 310 right now. That is Honasa coming up with not large volumes, but it's got some right now. Devyani is another one which is down about 1% or so at this stage. And some gainers, apart from what you guys mentioned, PFC is up 3%, is the top volume traded gainer, by the way, across the board. There is Brigade, another management you will hear from in just a bit on the program here. Brigade is up 5.5%. So that's a strong gainer. Yesterday, Prestige was very, very strong. Nazara Tech is up about 2.6%. MedPlus is up about 4%. And there is a fair bit opening up. Market breadth is positive, although it's nothing gangbusters. It's 1,100 stocks higher and about 800 stocks which are lower right now. Sonia.
Guys, are you sure you're contributing enough to United Spirit's earnings? Because that stock is under pressure. So, it's a festive season. Come on, you need to kind of do your bit.
On the weekend. Try to contribute.
Sonia's message, start chugging. Anyway, well, more on that later. But 30 points lower is what we have on the Nifty, 19,415 on the index. Gautam Trivedi is with us now. He's, of course, our market master of the day, co-founder and managing partner at Napier Capital. Gautam, great to have you with us here. Thank you very much for your time. Good morning. I believe you've just returned from a trip to the US and you've had the opportunity to sort of sit down with many investors. What's the mood like? I mean, positivity and optimism from what we read and what we hear and, our interactions in terms of attitudes to India and investing opportunities here seems to be at a peak. I mean, pretty high, pretty good. Go on.
Yeah, Prashant, thanks for that. I think the fact is that on this specific visit, I met a cross-section of investors, including a few college endowments, institutional investors, family offices. I think the interest in India clearly is at an all-time high. I've never seen this before, and clearly at the expense of China. So that's the good news. Having said that, I think there's a bit of a wait and watch with respect to incrementally putting new money to work in India. And that's coming from the fact that we are still the most expensive market in the world. So there's no, running away from that, unfortunately. And I think even though we've seen over $5 billion of selling by foreign portfolio investors in the past just over 2 months, in spite of that, I think a lot of that has been offset by domestic flows. So until the domestic flows don't slow down, I don't see a deep correction in this market. And that seems to be, I think, a bigger problem with respect to putting incrementally more money to work. So that's the first point, I think, which I came out with. The second, of course, was, with respect to the price of oil. And I discussed that with a lot of people. What I found from them, and this is interesting, that a lot of them believe that, yes, the Middle East crisis and the war will be a prolonged one, unfortunately. That's at least that's the general view out there. But the price of oil may not necessarily go up incrementally too much from these levels. It may cross $100. I'm not saying that it won't happen. But the fact is that as oil keeps moving up, the view, at least in the US, is that renewables become even more economical. So given that effect on renewables, I think even the oil-producing countries are pretty smart, and they do understand that taking the price of oil up way too much above $110, $120 will end up hurting them in the longer term. So I think these are some of the issues that I came back with.
Okay. So what does all of this mean from an equity standpoint, Gautam? Thanks a lot for joining in, and
Sure.
season's greetings to you and your team.
Thank you.
This year has been very good for Indian equities, right? Do you think that we can build on to these gains in the next year as well?
Yeah, so we're up about 6.5% year to date in rupee terms. Dollar terms, of course, it's not that great. But if I look at the overall emerging market pack, and I think that's something which we are part of, if I take out China, which really, there's complete lack of interest in putting incrementally any new money to work in China, in spite of the valuations. MSCI China, for example, is at 9.3 times calendar 24 PE. We're at 20 times. So we're at 115% premium to China. And in spite of that, the lack of interest remains in China. So I think, like I said, I think the incremental flows from FPI investors will be muted into early next year until we don't see a significant correction in our markets. We did have a 5.5% or so correction from the peak in the month of September, but then again, we've seen about a 3% rebound. So I think that clearly remains a concern for foreign investors. And I think, the fact is, domestic investors have a lot of faith in their own country, which is India, and as a result, continue to put money into the equity markets. So that fund flow from domestic investors, to some extent, is keeping our valuations elevated. And as a result, I think to expect more portfolio foreign flows at this point would be a little optimistic.
Hi, Gautam. Good morning.
Hi.
Good to see you in. What about HDFC Bank? I think we chatted a couple of months ago, and you said that you're not expecting any big outperformance for the next 6 to around 9 months because things need to sort themselves out. But what's your view on the stock? Is it providing a good entry opportunity? Valuations in favor? Banks have been really something that most investors have been looking at. Earnings haven't disappointed in that space. Your view on the big name HDFC Bank, because that's been a big underperformer actually.
No, it has been an underperformer for the past at least 2 years that I've been tracking it. We own the stock, so full disclosure there. But I think from a longer term perspective, it's definitely the bank to own among the private sector banks, and that's the reason we have it. We also own ICICI and Axis, but I think given valuations today, you're getting it at nearly 80% discount to what it's historically at in terms of price to book. So, hello? Can you hear me?
Yes, go ahead.
We lost you for a bit. You're back with us. Please go ahead.
Yeah. So I think valuation-wise, it's very attractively priced. And my view is that from a foreign portfolio investment standpoint, if you look at the total pie of the money that foreigners have pumped into India, their mark-to-market value is about 650 billion. Of that, financials are about 33%. So that's the biggest chunk of the FPI holding. And if you look at it, even this earnings season, banks have been actually performing the best results that we've seen, and they've surprised us across the board, including the PSUs. I don't mean just the privates. So my view is HDFC Bank, you will make money over the longer term, but and now would be a good point to get in.
Okay, so that's on banks. I wanted to understand, generally every Samvat, every Diwali, we talk about the big themes to watch out for, right? And we sort of get some ideas, some nuggets here and there. If you had to identify for us a couple of big themes that retail investors should look at over the next 1 to 2 years, what would they be?
Well, I think you're looking at sectors that didn't exist until about 4 to 5 years ago, and I'm a big fan of the EMS business. If you look at the top line of these companies, of course, EBITDA margins and EBITDA performance has been mixed. But if you just look at the absolute top line of these companies, they're growing anywhere from 40 to 50% year on year. So I still think that the EMS business, while it's not necessarily cheap, a lot of these stocks have had a great run over the last 12 to 18 months. But the EMS industry in India is where the IT industry was 25 years ago. And a lot of these companies are going to be multi-billion-dollar market cap companies over the next 5 to 10 years.
But profitability-wise, Gautam, I mean, you look at some of these, EMS type companies. The big ones are based out of Taiwan, etc. Margins usually are 1.5%, under 2% broadly across the board. And these are well-established companies over the last 15, 20 years. So is that what we should expect here as well, profitability-wise? Even as growth rates, as you say, absolutely, will be strong.
Yeah, so you have even now of the 9 odd listed companies, and more are coming, I believe, in terms of to get listed. If I look at the breakup of that, and the two companies that were the poster child of the EMS industry, Dixon Technologies and Amber, they're more assemblers rather than actually doing significant value add. I mean, they're great companies, but I'm just saying their business model is more assembly oriented. As a result, their EBITDA margins range from 3 to 3.5%. But if you look at some of the other companies which are doing printed circuit boards, RFIDs, these guys are having anywhere from 9.5 to 11% EBITDA margins. So really, you need to figure out where you want to put your money incrementally in, and you got both models working beautifully within the EMS space.
Okay. Well, we've run out of time, but I want to just get a quick word from you on some of these power stocks, because we are actually heading into a discussion with Tata Power. So just before that, very quickly, is this a space that you like and something that you would recommend?
It's a space I like. It's a space I've missed out on, and I'm honestly waiting for a better entry point.
Okay, then perhaps you'd want to listen into the conversation that we're having with the management. Gautam, happy Diwali to you. Thank you so much for joining us, and have a great, great year ahead. We'll, of course, chat with you.
Wishing all of you.
Yes, thank you for your wishes. But let's get the focus on Tata Power. Strong set of numbers this quarter. The Mundra performance has aided the quarter earnings, and the Odisha operations also continue to see improvement. Praveer Sinha, the Managing Director and Chief Executive Officer at Tata Power, is with us. As always, he'll give us a sense of which way things are headed and also how the industry dynamics are looking. Mr. Sinha, good morning. Happy Diwali to you and your team, and thank you for being here with us on the channel. I wanted to start by, talking a little bit about the Mundra performance. The performance was good, but the coal contribution has come down. Given the extension of Section 11, what are the kind of profits that you are penciling in for Mundra over the next 1 to 2 years? And does it push out the long-term PPA chances?
Good morning, Sonia, and happy Diwali to you and all your colleagues in CNBC. I think the performance has been good this quarter, and this has been on back of a good performance from all our businesses, including Mundra. The Section 11, of course, has helped us because under Section 11, we get the cost, which is the actual cost of power generation. So it's a pass-through arrangement which is there, and to that extent, the restitution takes place. And whatever cost is incurred, we get a reimbursement of that. And we expect now that it has been extended up to June 24, and the demand of power being so high, it is expected that this will continue. However, we have been in discussions with the procurers, and hopefully we'll come to some sort of an arrangement much before the Section 11 gets over. And that will help us to have a long-term arrangement. Nonetheless, the Section 11 will be there for quite some time, considering that there is a huge growth in demand, and we have seen last 2 years the growth has been 10% each year. So nearly 22% growth has been seen in last 2 years. So with the type of extreme weather conditions, the type of growth, industrial growth in the country, we do expect the power demand to continue in the coming years.
So, sir, can you put some numbers to the kind of path to profitability for Mundra? I mean, what are you penciling in?
We are not looking at profitability, but we are definitely looking at a cost reflective. So earlier we used to have huge losses in Mundra. That will not happen. So it will be cost reflective and cost neutral to that extent.
Hi, Mr. Sinha. Morning. Thanks so much for joining in. Just a quick question on this Coastal Gujarat Power Limited. What kind of ROE are you making here?
So as I mentioned to you, we are not making ROI or ROE in that. It's a cost reflective. So today there is no negative cost on operation of Mundra, which we were because of the increase in coal prices, we were not getting the full pass through as per the original PPA.
Mr. Sinha, we'll just come back to specific segments of your business in a bit, but good morning, Prashant here. The union governments recently organized a 2-day conference with states on laying out the roadmap for meeting power demand, etc. And the power minister, the union power minister, Mr. R.K. Singh, there's a PIB release. He basically said that we need 80,000 megawatt of sort of thermal power construction which needs to happen to meet future demand. And of course, I mean, the minister said very categorically that we will not shy away from coal-based power to meet this demand, because even as they kind of sort of aspire to meet all the sort of COP targets and what we've committed to, etc. So in that context, Mr. Sinha, I mean, power is a very sort of closely aligned with government policy and with the government push, etc., thrust, etc. Are we looking at a big thermal cycle? We've spoken about this in the past, but since this just happened 2 or 3 days back, just wanted your thoughts.
I have not seen the details of it on what basis, but as you know, we also have a very ambitious plan in the country to have 500 gigawatt of clean energy by 2030. And that also means that 300 gigawatt of clean energy will come between now and 2030. And within Tata Power also, we have a very ambitious plan to add green capacity. We already have 5,300 megawatt of green capacity right now. And another 3,700 is under implementation. This also does not include the 2,800 megawatt of pumped hydro. So what we are trying to do is come up with good solutions, unique solutions, where we will be able to give 24/7 green energy, and a hybrid of solar, wind, and pumped hydro can be a very, very good alternate. So our plan is that we will go the route of clean energy solutions and give 24/7 clean energy, and that's the way we will implement our projects in future.
Okay, that's interesting because I mean, if I read from the minister's comments, he says that we need about 80,000 megawatts of thermal capacity under construction. And he says all this capacity addition is being done through the public sector. Private sector investment has not started coming, but I'm quite certain that private sector investment will come. But you're saying that the preference for Tata Power will be renewable. I mean, that will be the big thrust in terms of sort of meeting power demand, the broader goals, the bigger goals.
Absolutely right. And we took this stand a few years back, and we continue to be on the script of going clean. And we will implement more and more of clean energy. We'll also implement more of pumped hydro and other hydro projects so that they can be mixed with the solar and wind and given 24/7 solutions.
Okay, all right. Mr. Sinha, I also wanted to ask you about the Odisha discom. That's the other one that's done quite well. Could you tell us what is the outlook from here on?
So Odisha discom, we've done a lot of improvements in terms of not only reliability of power, but also customer services. The ERP has been implemented, and many of the billing solutions which were not there earlier have been implemented, and we have now a better line of sight in terms of billing to all the consumers who were not earlier in the consumer net. We've changed nearly 25 lakh meters in last 3 years. And to that extent, the accuracy of billing and correct billing is being ensured. So we do expect that many of the initiatives that we have taken will get stabilized in the next 6 months, and the results will start coming in the next year onwards. So we do expect a huge amount of improvement that you would see in the Odisha discoms going forward. And the results of many of the initiatives will be there for us to see.
Okay, I want to understand a little bit about the solar business also, because the solar EPC margins so far have been muted, but the order book is very strong for Tata Power. So just wanted to understand, is there a lot of raw material price fluctuation? And given the timelines of the upcoming CELU and the module plant, can you tell us, do you have scope to take the margins up further? If yes, what is the kind of band that you're looking at in the solar EPC business?
So if you remember last year, the prices of modules had gone up and many of the projects were slowed down. Now that the prices have come down, we have tied up huge quantity of modules. And you would see that between now and March, we will be implementing nearly 1.5 gigawatt of projects. And many of those projects which were delayed will get completed by March. So next 2 quarters, you will see huge amount of investment happening in the renewable business, and the results will start coming from there on.
Okay, and you have this factory coming up as well, right? So once that comes on board, then what kind of an overall growth are you looking at in the solar EPC business?
So this is a 4.3 gigawatt solar cell and module manufacturing unit, the biggest one in the country at single location, and the first one under the PLI scheme. And the objective is that majority of our requirement for our, whether it is for utility scale or third-party EPC or rooftop, will come from this plant. And to that extent, we'll have much better visibility on the cost of the solar modules and also control on the quality of solar modules. There would be some extra quantity available with us, which of course we will be either selling it internally or also exporting. So come next March, April, we'll see a huge amount of capacity coming from this plant. And we do expect by then that the visibility and the control on cost will improve drastically.
Okay, all right. Mr. Sinha, thanks a lot for joining in. Once again, happy Diwali to you. And thanks for being with us here on the channel. Let's slip into a quick break. On the other side, we'll be joined by Pavitra Shankar, the Managing Director at Brigade Enterprises, to discuss the company's Q2 performance. Later, we'll also be joined by Vinati Mutreja, the Managing Director at Vinati Organics, to discuss their Q2 earnings.
All right, well, 20 points lower is what we have, 19,422 on the index, and there is a fair bit happening. Mark, the advanced decline ratio, it's still early. I mean, only, I think 20 minutes or so, a little more than that, but it's narrowing. The gap is narrowing. So about 1150 stocks are higher and 900 stocks are lower, as you can see up on your screen. Maybe just take a look at what else has come off, more. So Renuka is down about 3%. Bajaj, actually a lot of sugar names. Bajaj Hindustan I can spot, and a few others. So this is a new addition to the losers list. But the rest are there, Midhani and Devyani, etc. We mentioned them in the morning. GE Shipping is a new one, which is down about 3% or so at about 744 at this point in time. Well, Brigade Enterprises reported a strong set of numbers for the second quarter. Pricing is up 9% sequentially, and there was good improvement in commercial sales as well. The hospital occupancy is at a 5-quarter high. Pavitra Shankar is managing director of the company. He's joining us right now to take some questions. Pavitra, good morning. Great to have you with us here. Thank you very much. At the outset, let me wish you, your family, your team a very happy Diwali from all of us, in case I don't get the opportunity towards the end.
Happy Diwali to you all.
Thank you. Thank you very much, Pavitra. Let's just start by talking about, just give us a real-time sense of how strong demand is as we are in the third quarter now. And give us a sense of the full year. How is it panning out to be? Will you be able to do 5,000 crores in sales for the year?
Hi, good morning. Thanks for having me. The year's looking fantastic on all fronts. Residential's been doing great. Of course, the demand on ground from customers is really good. All of our new launches are doing excellently well. Under construction inventory completed across the board, the demand is really fantastic, not just in terms of sales velocity, but also pricing. So we've been able to increase pricing and there's no reduction in terms of demand from the customer on that front. So the outlook is also pretty good for the rest of the financial year. And as far as we're concerned, we are pretty bullish on the residential market for the next couple of years as well. So we are going strong in terms of launching projects, adding to the land bank, launching and moving from land bank to the launch pipeline. On the hospitality sector also, it's a really very good bright spot after some tough times. So all the hotels are doing at very good occupancies, and the average the ARRs have been improving as well. So upcoming wedding season should be pretty good for the hotels. So we are expecting hotels to do well too. On our leasing side, of course, collections, revenue, all that is going smoothly on both the office and the retail. Retail consumption has increased. And again, we're seeing the festive season. So we're expecting good things for the malls, which we're seeing in terms of footfalls as well. So only on the leasing side, we're chipping away at it since we have SEZ space. And of course, it's not looking like there's some major movement on the regulatory shift for the SEZ regulations. So, but we are still able to lease out. This quarter, we did about 0.3 million square feet in our remaining space. So I think even the leasing is going on a good front. So on all things considered, I think it's good times. We posted a good quarter supported by registrations as well. So that flew into the revenue numbers also.
All right. Hi, Pavitra. Good morning. Good to hear the commentary that you're giving us. And you're clearly sounding very, very optimistic. And as you said, bullish about the future prospects. Let's get a couple of numbers going, though. The sales number, will it do more than 5,000 crores for this year? Point number one. And realizations have moved up by around 8 to 9% on a sequential basis. More price hikes in store?
Yeah, so, the way we look at price hikes is, seeing what is possible from an inventory movement standpoint. It's, of course, important to move the inventory at a price that we think is fair, and then see if we can take up pricing and it's accepted by customers. And so far, that has been the case. And we think that it should continue on that front. In terms of sales numbers for the rest of the year, it's highly dependent on launches. We have about 6.5 million square feet of launch for the rest of the financial year itself. So a lot of our launches got pushed into the second half. So assuming all of that comes in, I think we should be in a good position, while I'm not necessarily commenting on the total value per se. But that's the hope that that's the idea. Once we get the launches, I'm not worried about what the sales will be.
Okay. But overall, I mean, you of course gave us a view on Brigade itself, but overall, how are you seeing the market, the residential market? Pricing has gone up for you, which means that, despite the kind of oversupply that we're seeing, the massive urbanization, pricing is still looking good, right? But now there is this issue that metro cities are facing, where on one hand there's rapid urbanization, on the other hand there's so much pollution. So the fear is that people will start moving out of metro cities. Do you think that could sort of restrict growth in the metros in the near future?
We'll have to see over time. I mean, naturally, the kind of huge metropolises that we have does require a lot of planning on the authorities' side in terms of urban planning. Town planning authorities need to put in a lot of these measures. Despite that, we are seeing, people moving back from the tier 2 cities. The thought process during COVID and immediately after that was that we would see a lot of people moving out from the large metros. But as work from home has moved slowly to work from office or hybrid, we've seen a lot of people come back. You can see that in terms of just the rentals across, the stories are quite notorious, say in Bangalore or wherever, in terms of rental price hikes or just trying to find an apartment. So I think that naturally tends to increase the demand for people looking out for their own homes. And so far, interest rates have also stayed stable for the last 6 months or so. The repo rate hasn't been increased, so therefore interest has also been, the mortgage rates are the same. So I think right now customers are just looking for the right quality, the right developer to go with. And when a launch comes out from someone like us, they're basically ready to book and make sure that they get the right unit that they want, because they're thinking about end user and occupancy. So therefore pricing is more of a second situation.
No, I take your point, but my only limited point here is you'll have the right quality in terms of the builder, but what if you don't have infrastructure? There's so much pollution, you just want to rethink your decision of spending that top dollar on premium housing, and you'd rather sort of move to a place where there's lesser pollution. Okay, that's a discussion for another day, but let me get back to the business, right? Leasing has improved this time. Of course, this was after weakness that you saw in Q1. So can you tell me, what is the annual exit rentals that you're looking at?
So as of half year, we've done around a little under 400 crores. So that should stay on track, because a lot of that will just grow at a stable rate. Some of the new leasing will just need to burn off the rent-free periods, and the lease rental will have to come in. But stabilized on an exit rental, we are looking at maybe 750 crores as a total rental portfolio today. That's with the operating assets. Sorry, that's with the operating assets that we have as of now. We also are constructing some. We are constructing some new office buildings. So once those also get rented and leased up, those will add about 180 to 200 crores on the top line.
Pavitra, very quickly before we let you go, there was a change in the Karnataka government. Have state approvals started coming through smoothly, or is that still a bit of an issue?
It's been a bit of a mix. Some things have happened smoothly. We are seeing a slowdown or just sort of a holding period in terms of some of the approvals coming through. But there are discussions, constantly on trying to push a lot of that. I think there are meetings that need to happen, for the authorities themselves. So yeah, we are seeing a bit of slowness on the approval side. Things had picked up after the government had just come in. It stabilized a bit, but now somehow we're seeing a few more delays. So hoping that it won't impact the rest of the launches that we have planned for the rest of the financial year.
Okay, all right. Thanks a lot for joining in, Pavitra, and all the best for the quarter to come. Thanks a lot for being with us. Let's focus on Vinati Organics now. It was a weak set of numbers for them. The company witnessed sequential recovery but continued to see pressure on a year-on-year basis. Vinti Mutreja, the Managing Director at Vinati Organics, joins us now to talk more about her business and the way forward. Vinti, thanks a lot for joining in. Happy Diwali to you and your entire team. Good to see you in your festive gear, and hoping this is a great year for your business. Year on year, though, there is some pressure that you've seen. The revenues are down 20%, EBITDA is down about 25%. Has there been any sequential recovery in demand, and what is the pressure? Where are the pressure pockets that you're still facing year on year?
Sure, sure. Happy Diwali, Sonia. See, year on year, actually, our revenues, in my estimate, this year we will not be down as much. I know in H1 we are down combined maybe 15% or so in revenues, but our merger with from NCLT for BHEL additives just got approved, but we're still waiting for the approval in writing. So once we're expecting that to go through in the next month or so. So from October onwards, the revenues of BHEL additives will get added to our financials, which wasn't the case in H1. Margins actually have remained intact at 27% of revenues, but the volumes have come down. Last year was a great year. Actually, we saw some excessive buying in a lot of our products, and hence by March, April, our customers were sitting on a lot of inventory, and this destocking has been going on, which will continue to do so in December itself. And that's why you see the overall bottom line being down by about 15-20%.
All right. Hi, Vinati. Good morning. Thanks so much for joining in. Well, how much will BHEL additives contribute for this year?
See, this year, I mean, it'll be just for 6 months, and it's doing about 30%, 40% of capacity. So maybe around 100 crores or so in this financial years.
Got it. And in fact, do you get the full impact in FY25? So what does it ramp up to?
Right. Well, hopefully we attain better capacity utilizations, close to 50%, at least 60%. So maybe around 400 would be my
400
target.
crores.
Yeah.
Lovely. All right. So we got that out of the way then. Now, your ATBS segment out there saw the highest amount of destocking. Is that coming to an end?
Well, December is the year ending for most of our customers. So we expect that, they would be sitting on zero inventory by December. And so they would start buying again from December, January for us, because the demand remains steady across sectors for ATBS. Hence, we are continuing with our expansion as well, which is on track to be completed middle of next year.
All right, got it. Overall, for FY24, what are you guiding in terms of revenues? I think the first half you've done about 900 crores. What kind of growth can you do in the second half?
Yeah, maybe a 10% growth from there, given BHEL additives and some ATBs, maybe 15%. I think we'll be just a little below 2,000 end of this year is my estimate.
Okay, below 2,000 crores on the top line end of the year. And what about in terms of the margins? I think your exit margins in the first half is about 25%. So what are you looking at in the second half?
So similar. I think the margins, mine are showing 27%, but yeah, similar EBITDA margins.
All right. Vinati, what about antioxidants, AO? That started contributing to revenues, I think, in this year.
That's the BHEL additives that we spoke about. That's the BHEL additives.
That's the one. Got it. Also, you were talking about some expansion in the ATBS segment, I think so. So what's the outlook out there with regard to the expansion?
So the expansion's on track. Our 10-year outlook on ATBS still remains the same. We think it's a product that has multiple uses and continues to grow over a longer term. And so that's expected to complete by June of next year.
By June of next year. Okay. All right. So it's pushed back a little bit.
Slightly. Yes, slightly.
Okay, all right. All the best, Vinati. Thanks for stopping by and giving us a quick take on the business and the way forward. That's Vinati Organics. Let's slip into a quick break. On the other side, we'll focus on the commodity markets. Manisha Gupta will be joining in. Stay tuned. Welcome back. For now, the markets, as you just saw on your screen, are very, very quiet. Not too much happening. But there are plenty of stocks in the broader market. So the mid-cap index is up almost about 115 odd points. And lots of stocks. United Spirits was one stock that's, trying to climb up on the back of a good set of numbers that the company has reported. But apart from that as well, Brigade Enterprises, by the way, after the management commentary, just look at that stock, 6.5% higher now on Brigade Enterprises, looking very good. The entire real estate space is looking good. So Brigade, Soba is also up about 5%. And then you have the tire space that's looking very good. So you have Seat, Apollo Tires that are all in the green. We had cracker numbers coming from Apollo Tires. So in 2 days, the stock is up almost about 10 odd percent. Mitesh Thakkar is with us. So let's go across to him to find out more. Mitesh, first on these tire stocks, is there still more upside beyond the kind of gains that we've already seen?
So I think there's a good chance of further upsides happening. See, I think, I was looking at the charts of Apollo Tires, Balakrishna and MRF. Now, MRF has been, sideways in the last 2 to 3 months, broadly doing a range of 10,600, 700 to about 11,200. There is a chance that we'll see a breakout above these levels soon. And once that happens, I think, it can head towards 1,20,000 odd kind of level. So very positive on that. Apollo Tires, which after correction has started an up move in the last 3 days, is now close to the resistance levels of 430, and then there's the all-time high of 435, 437. So I think around these levels, you might see the stock take a breather, but eventually I think it'll cross and break into all-time highs. And similarly, Balakrishna Industries is at the all-time highs. I think it's never had a closing about 2,610. And I think today we are seeing the stock trade above that. But the structure is also positive, so I think that could also, suggest a breakout and head towards 2,700, 2,750 zone. So quite positive on the towers, on the tire stocks.
Right, all right. Mitesh, I want to ask you about a couple of other names. Mahindra and Mahindra, that one has moved up. It's up close to 2.5% as we speak, and it's, been trending for the last 45 minutes or so. Your view on the stock, where does it hit resistance?
Neither is one of my recommendations. I think, on the intraday charts, what we are seeing over here is that the stock has kind of reversed after giving a good correction. And now I would recommend buying this with a stop below 1492 for targets of around 1585, 1590 on the upside. So that's one. And the other one is Dixon Technologies. I think that's also after a pullback is trying to get on the upside. So that's a buy as well. Keep a stop at about levels of 53.45 and a target of 5,500 is what I would recommend.
Okay, all right. Mitesh, have you looked at Genius Power, on the charts? I'll tell you what, that stock in this year is up 200%. It went to around 300 rupees and Genius Power actually has corrected from there. And, every time it goes to this vicinity, it's seeing some selling. Have you looked at it on the charts? It's at around 250 rupees now?
Not much, honestly. I think I've not been tracking the stock regularly, unfortunately.
Got it. Okay, all right. Mitesh, so we'll let you go at that. We'll, reconnect during the course of the day and get the other picks as well from you. By the way, just take a look at PFC and REC. Both of them, they're blazing away. They've moved to the high point of the day. So those stocks, in fact, they continue to do well. They've re-rated this year itself. And on the flip side, Godrej Consumer, the stock has slipped in the last few minutes. So let's pull up the intraday chart out there. You have the stock that opened up in the green, but now Godrej Consumer has moved into the red. For the time being, though, we'll slip into a short break. When you come back, we'll turn our attention to the commodity space. Manisha Gupta will be joining in. Welcome back. Well, we're trading for the last 45 minutes or so, and I'll tell you what, the Nifty is not moved. The Nifty is as flat as can be as we speak, just a point movement on the downside. So that's been that sort of a market. But in the broader markets, plenty of stocks are moving around. But we've been telling you about the equity markets for a while. So let's turn our attention to the commodity markets. Manisha Gupta joins us as always to tell us what's going on there. Manisha, over to you.
Thank you so much for that. You know, it's a good time for consumers. You have crude prices down, gold is corrected quite sharply on the lower side. And the other thing that you buy during festivities is clothes. And the cotton prices as well are trading at a 12-month lows in the international markets. As per the International Cotton Advisory Committee 2023-24, when you look at the global production numbers, well, that is expected to increase by nearly 3%. And the markets are looking at higher production in the global markets right now. The not so good news really comes in from the consumption numbers, where we have seen nearly 0.5% of a decline. So these are the exact numbers really for the next season. 25.4 million tons of production, consumption expected slightly lower, and the warehouse stocks is expected quite comfortable at 14.5 million tons there. So when it comes to cotton in the global markets, whether it's about textiles and various other industries associated with it, we are looking at production higher, consumption not so much, and the margins really getting impacted. Large crops internationally for cotton are expected in countries like Brazil, Argentina and Tanzania. Not so great crops coming in from US, Australia and Greece as well. For the Indian markets as well, we have seen a bit of a hit come in for the crop this time around, and not so much for a crop but the yields as well. So the production is expected down 6% on a year-on-year basis when you look at the Indian cotton crop this time around. So when you look at the production itself, we are looking at around 31.65 million tons, which is the lowest in last 15 years when you look at those numbers. If you look at the last year as well, the crop was higher at 31.89 million tons, and 15 years ago is what we are comparing ourselves to in 2023-24. At that time, the crop was at 29 million bales. So that's as low as what we've gone in sense of crop productions there. When you look at the Indian cotton demand as well, that is estimated at 31.1 million bales, which is lower in what we saw in the previous year as well. So even as there is crop coming into the markets, the arrival are slightly slow, one, and two, the demand is not so strong at this point in time. The Chinese demand also continues to be on the weaker side, and that has had an impact on the prices. So in last 1 week, we've seen the prices decline by 6%, and the global cotton prices have fallen by 12% in last 1 month itself.
Okay, all right. Thanks a lot for that, Manisha. But let's focus on some big movers in the first hour itself. Upasana joins us to tell us about MTAR Tech. The stock is under big pressure. Upasana?
MTAR Tech has reported its Q2 FY24 numbers, and the company has also revised its annual guidance for FY24. In terms of the annual revenue guidance, the company has cut it by almost 25% to 670 to 700 crores. In terms of EBITDA margins also, the company has cut its margin guidance for FY24 from 28% to 26%. Now moving towards the company's financial performance in Q2 FY24, the revenue saw an uptick of almost 32% on Y-on-Y basis. The other income was down by almost 85%, impacting the PAT growth. And the total expenses also hiked up by almost 44%. That's why the margins were impacted. Coming to EBITDA margins, it stood at 21.7% versus 27.7% for the quarter. Now, in terms of order book, the order book of the company stood at 997 crores, and company has locked almost 80 crores of new order in Q2 FY24. So all in all, we are seeing a weak set of numbers coming in from MTAR Tech, and also the guidance cut is something which we should be noting.
Well, that's clearly weighing on the stock. Thanks a lot for that, Upasana. Well, focusing on Welspun Corp, those numbers look quite good out there. On the top line, there was a big growth. In fact, there was a doubling of revenues. A couple of factors played out. They're already won big orders. Execution is picking up, particularly in the US business as well. And in addition to that, you had the others in the plastics business that contribute roughly around 150 crores on a quarter-to-quarter basis. So that's one factor that resulted in this big surge on the top line. Volumes as well have picked up. Now, on the EBITDA front, it comes in at around 400 crores odd, but there's a one-time impact of close to around 50 crores. That's due to the cyclone, and that's inflated the other expenditure. Otherwise, the EBITDA number would look far better. Margins on a sequential basis as well have improved from around 9.1% closer to around 10%, and that includes the one-time impact in there. The net profit as well looked quite good, and the other numbers that they've given is quite good. The total order book size is close to around 8,000 crores, so that's something that's good as well. And the net debt number has been gradually reducing, and that's come down by another 500 crores. So that's why, in fact, those numbers go down as a beat. Well, for the time being, though, we'll slip into a short break. But on the other side, you don't want to miss this conversation. Lata will be catching up with Amitabh Chaudhary, Managing Director and Chief Executive Officer at Axis Bank, to discuss the past quarter's numbers and, more importantly, the way ahead.
Welcome back. It's a Diwali special guest, Amitabh Chaudhary, we are waiting for. But while we get Amitabh on the line, let's apprise you of Nazara Technologies as well. The stock has slightly done better after the challenging times it saw. Rima is here with the key takeaways from the results. Rima.
Thanks so much for that. So this is a gaming company. It is esports. It even has gamified learning, the Kidopia app for children under the age of 5. And plus, it's now dabbled into gambling, the real money gambling, which got impacted by the 28% GST on entry fees. So here are the numbers for Q2. The top line growth has come in at 17% quarter on quarter. Year on year, it's a growth of about 13%. EBITDA margins are higher on a year on year basis, but sequentially, there is a decline in the margin. And that's because the company has spent more on acquiring content or event costs. They also do a lot of live events. Profits for the company have actually doubled on a year-on-year basis. Now, if you break up the top line growth, right, of about 13%, esports has done well for the company, gamified learning for the company has done well, but the ad tech revenue, now that has come under pressure because the company has said that they are trying to get away from the low margin business. They're also trying to expand their client base so that they're less dependent on, a select few clients. So because of that, you've seen a sharp 35% decline in the company's ad tech revenues, where they help companies monetize, on a gaming platform, you will see ads, right? But which ads should be there? How do you make the most of it? That's done by this company, ad tech. Now, on the, touchy topic about the GST revenue, which impacted their real money gaming business. Remember, it's not a huge impact because it's less than 5% of their overall business. But here's what the company had to say. Okay, Classic Rummy, which is the real money gaming, is likely to report a loss in Q3. Back to you.
Okay, I'm sorry I'm hurrying you. Our guest is with us. Thank you very much, Reema. Well, so like I told you in today's Diwali special, we have a banker who posted a cracker set of Q2 numbers. We have Amitabh Chaudhary, Managing Director and CEO of Axis Bank. Well, I said it was a pataka result because I think Axis was the only bank, large bank, to have posted a higher margin than in the previous quarter. Every other large bank, and the comparison will run for you, did show a fall in margin, some of them even to the extent of 25 basis points. Also, the fall in gross NPAs for Axis was much more than for comparable banks. So, without much ado, welcome Amitabh, and many congratulations for a great set of numbers. Okay, let me start with the bread and butter questions first. Credit offtake, excellent loan growth at 23%, both overall as well as retail. Now, you've seen the festive season demand, you've seen the Diwali demand. Do you think Q3 will do better?
Firstly, Lata, wishing you and your team members a very, very happy Diwali. Thanks a lot for coming here. Yes, well, there are strong signs that the economy grew stronger than 7% in real terms in the September quarter, and the momentum has continued thereafter. We are seeing, if you look at some specific sectors, cement, construction demand, power demand, I mean, there are very clear signs that some of these things are picking up. Profit growth for the corporates in the second quarter has been strong. And this is happening despite the economy facing fiscal and monetary headwinds. So from my perspective, while RBI is keeping liquidity tight, likely due to global uncertainty and dollar shortages, my view is that the credit offtake will continue at the similar pace as what we have seen in the past. Some banks are growing at a faster pace. But at the same time, and in the same breath, I have to mention that the deposit growth continues to lag. It has been tough. Most of the deposit growth is coming in the form of term deposits rather than CASA. You saw CASA drop for most of the banks in the second quarter. And if this gap continues, at some stage, this gap does need to be bridged. So we cannot have a situation where credit growth just keeps, being ahead of the deposit growth for a long period of time. At some stage, they do need to converge. And my only worry is that if they don't converge, then we'll be forced to converge. Otherwise, the economy seems to be doing all the right things. And from that perspective, the prospects look bright.
Okay, well, actually, then let me upgrade the deposit question that was anyway going to come. You did about 17.5%, 18% in terms of deposit growth. Now, obviously, last quarter, there was this one big bank which was aggressively picking up deposits, and you also had the ICRR imposition. So deposits went through a challenging quarter. Now, will you go aggressively after deposits? I mean, and if that happens, what is the target, internal target, and what does it do to margins?
Well, Lata, we are trying to balance a number of things at the same time. One is that obviously deposit is the starting base for everything. So we have to get the deposit growth right. At the same time, we want to ensure that we do it profitably. You want to ensure that the NIMs are maintained. Third, if you go aggressively after deposits, you are in a way spoiling the entire, your liability franchise by making them fall into a habit of waiting for that extra aggression to go and get and source deposits. That's not the right way to build a long-term franchise. And actually, Axis has been trying very hard to move to a state where, on a quarter-on-quarter basis, we sustain what we do rather than do these one-off things which then come to hurt us later on. So from our perspective, it's a bit of a balance. Balance on one side where CASA is difficult. Term deposits, especially the retail, yes, are growing at a faster pace, but we need to ensure that they don't come at too high a price. We don't want to rely too much on borrowings and wholesale deposits. And at the same time, we would also like to maintain NIMs. At the same time, we would like to capitalize on the growth, the credit growth, which is available in the marketplace. It's a fine balance. We obviously are watching the numbers on a daily basis. We have some medium-term plans in mind. We have some obviously short-term. We have to react to what is happening in the market. So I'm giving you a long answer. And if I was to give a one-line answer, it's not a simple answer. It's a complex answer. And the answers does differ a little bit depending on how the market plays out. So from that perspective, we are just trying to find the right balance. And I think our numbers in the last quarter reflect that. We have obviously our deposits priced much faster than some of the others. And we were able to do a number of things on our cost of fund side and on the yield side, which allowed us to bring the margins up a little bit. It is a constant, battle in that sense. And at the same time, we were able to deliver a good credit growth. But
okay, let me tie you to a number there. Yeah, sorry. Exactly. That was going to be my question. Balancing so much is not easy for a very long time. So do you think you will be, how much will the margin crunch be in the current quarter or for FY24? Will you have to give away 10, 20, 30 basis points?
Well, we believe that the marginal cost of funds has broadly stabilized. We expect deposits cost, however, to increase further over the remaining part of the financial year. But the pace of deposit cost growth, we believe, will most likely moderate. See, from a guidance perspective, that's why we have been quite careful. We have said that our margin guidance is 3.8%. We have built a cushion of 30 basis points over that. Okay. And our endeavor would be to retain as much of that cushion as possible, led by multiple structural drivers we're working on, both on the yield side and the deposit side. So I don't want to give a guidance, but I only want to say that our real effort all this while has been to ensure that we keep this cushion as much as possible, though there are various variables which are moving and moving quite rapidly.
Okay. All right. Now, let me come back to the loan growth story, because there I want to get some more detailed answers from you. While retail credit also grew by 23%, your personal loans and credit card have grown by 39%. Now, the RBI itself has, put that on the table in the monetary policy statement, saying they are worried about personal loans and these would be unsecured loans. Yes. So are you consciously bringing it down?
So on the credit card side, the significant growth you're seeing is because of the base effect. We did not have Citi in the last year numbers, and we have Citi credit card numbers in this year. So credit card growth is good, but it's not as large as it seems because, the year-to-year comparison has Citi missing in one of them. Yes, the personal loan growth was quite reasonable and we're quite happy with it. It is one of the key drivers of credit growth. While the normal PL has grown by 2x in the last 2 years, I mean, that the small PL has grown by 4 times in the last 2 years. If you look at, Axis Bank, 85% of our growth is coming from existing to the bank customers. We have not seen any. The way we are growing and the reason we are growing is not because we are changing our risk guardrails. The reason we are growing is we are stacking our customer segments differently. We are attacking some of the distribution channels where our presence has been limited. We are asking and improving the customer journeys and the distributor journeys. So it is all about making your business more seamless to the customers and to the distributors rather than doing anything and changing anything on the risk side. So we are not taking additional risk. Yes, because others seem to be taking additional risks, we have to be watchful of what we are doing. So we are watching our portfolio very, very closely for any signs of stress. We are not seeing that, but we're fully cognizant of what the governor and RBI has been indicating for the last couple of quarters, that they're worried about the rapid growth in personal loans and some of the stress they're seeing in the system. And we are also watching it closely and obviously sharing some of that data with RBI. Right now, as I said,
if you can share something. No, I get it. If you can share something with us, I'll tell you why. Because Cholamandalam, when they did their conference call, they specifically said that their new segment loans have shown a higher NPA of 4%. And loans that originated from fintechs have, over a 12-month period, shown a lower NPA of 10% plus. So, I mean, do you all have fintech originating loans in your bank? Have you done that kind of granular detail to be sure that you won't have an unsecured loan shock?
So, Lata, we monitor our loan portfolio across partners, across customer segments, across geographies, across loan sizes. All the cuts are done, right? And as I said, we have not seen any major concerns yet. We have, amongst the larger banks, we have the largest number of, fintech partnerships. And we have 2 large fintech partnerships where we are doing PLs. We are not seeing any signs yet. But then, let me immediately add a disclaimer clause there. We have been very clear that we will do the underwriting. And we are applying the same underwriting standard. Does not matter it is a DSA or a fintech or it is our loans which are being originated by our own sales force. So in that sense, yes, sometimes the data which is a little is different. Sometimes you need to use a different data set to reach the same conclusion. But we are not changing our underwriting standards at all because it's a fintech. It's just a source of a customer for us. So in that sense, we are not seeing a difference. That does not mean that the difference will not emerge. But my worry is, and I don't know with the specific data about Chola, but obviously I know about this 10% data point which you mentioned, that maybe in some of the fintechs which they have a partnership with, maybe, I don't know, that the underwriting or the way the underwriting is being done or the way the growth is happening maybe is happened at a pace where some of these loans have gone bad. Maybe the size of the loans is quite small. And I'm sure, knowing Chola, they'll be taking corrective actions around it. We have not seen anything as yet.
That is very reassuring that, you're also privy to all this data and you are already doing that kind of granular underwriting. Now, just one more piece of worry. Maybe I'm connecting the two unconnected things, but we have seen a growth in equity derivative volumes. There was that excellent report from your mutual fund. Now, separately, there are these personal loans growing. Is there any doubt in your mind that personal loans are being used to, take punts in the equity derivative market? If that is, are you looking at, when you give a loan, where it is being spent? Is it going to depositories? Is some such trailing being done?
Well, if you look at the growth in volumes on the derivatives side, it is alarming. And we also know the data very clearly shows to us that it's been publicized quite well that 95% of the people lose money. And we are also seeing signs that some of the employees generally, broadly in the banking system, are resorting to wrong practices because they have drawn up debt at a very, very rapid pace. And in some of those cases, it is around betting or, let's say, taking positions on derivatives or whatever they might be doing. Because, why have all these betting companies and why some of the, derivatives have prospered so much? Someone is obviously taking some risk. And if everyone is losing money, they're paying for it. And that's why the kind of customers you're lending to and the profiling of the customers you do is very, very important. As we said, 85% of our lending is to existing to the bank customers. We do obviously monitor the transactions that are happening in those accounts. We also look at the profile of the customers. We also look at their, what is the leverage they have, how many loans they're taking, what they're doing about it. So it's a constant process. It is not that they give a loan and then forget about it. And yes, we are monitoring it. It is a worrisome sign. That's why our mutual fund came out with it, that, this is something which is happening, which should be looked at. Because, end of the day, if I run up debts, something will happen. Something has to give. And it will impact the system broadly at some stage. Maybe that's why some of the statements and the commentary is coming from RBI also. So let me just say that we are watching it very carefully. Yes.
Okay. Well, just a final question on credit cost. Even that's fallen admirably for you, more than it has fallen for other banks. Is this the best you will do, or is there scope to do even better?
So, Lata, we have been tightening our underwriting and credit standards over the last 5 years. And obviously, what you're seeing today is a result of all the belt tightening that has happened. In my view, we have been saying again for the last couple of quarters that this is some of the historical lows you have seen for the banking system. It would move towards a more normal kind of credit cost. We have talked about 60 to 80 basis points, which is lower than our long-term average. We don't know where it will finally end up, but some of the costs which you're seeing right now are at historical lows. And as a bank, we are in the risk-taking business. So for us to hope that this will continue, I think it will be a bit unfair because we are also growing on the credit side at a reasonable pace. So I would say 60 to 80 basis points is more the number we should be looking at rather than where we are today over a period of time. Let's say how much time it gets there. It takes to get there.
Okay. Well, anyway, it's a cracker set of numbers. Many congratulations. And here's wishing you and everyone at Access and your team a very happy Diwali.
Thank you so much, Lata. Always a pleasure.
Okay. Well, that's the word from the big man from Axis. They are keeping their eyes really wide open for any signs, but very ambitious on growth and on asset quality. Wrap up on Bazaar on that note. Chartbusters up.